see. Don't forget to get the copies for yourself and for others. Okay. Now, of course, in the previous classes, we've been looking at shares issued payment in installments. So last class we looked at call in advance. Okay. All right. And then in this class, we're looking at okay. Now, if you recall what we're talking about, raising funds through issue of shares. So you're telling people to come and be part of the owners of your business, but you're going to pay for it. And then we talked about, getting the funds from the investors or the shareholders or the applicants in installments. Okay. So remember let's say our application and allotment. We can have first call, we can have second call. Okay. So remember I told you that upon application allotment you might want to raise an amount of money. So let's say this is 30 kobo. Here let's say it's 20 kobo. Or let's even say this is 30 kobo as well. And then here let's say 40 kobo. Okay. Alright, so this is application allotment, this is first call, this is second call. Alright. Now it is possible that the applicant or the shareholder or the investor makes payment for what? Application allotment. Let's even say he makes payment for what? First and second call. Now it is possible that when he is called to make payment for second call, it is possible for him not to be able to make what? Payment as at when due. Of course, remember that is called in what? Arrears. If you remember, there's a class on call in arrears already. So what we're saying here is that the shareholder or the investor or the applicant was not able to make payments as at when due. So what we're saying is that he has made this payment, but when they called him to come and make this payment, he was not able to make the payment. So that is called in what? Arrears. Now it is possible that this guy that could not make this payment, it is possible for him, due to some reasons, not to be able to still raise the money within the timeline given. And usually the directors are expected to, of course, protect the investment for the guy, so that he'll be able to look for money within that period. Okay, to what? To make payment. But it is also possible that, while the directors had tried or put in some efforts to ensure that this investment is protected, the guy might still not be able to make payments. And usually in that scenario, of course, it is possible that the guy will now lose the ownership of the shares. So in that scenario, we say that the share, okay, has been forfeited. So what we're saying is that because the guy was not able to make payment even after giving him all the what protection required. Most cases, or in most cases rather, that shareholder will lose the ownership of that what shares. So we can simply say that what forfeiture of shares is just what saying, or is the same thing as what we can say loss of what share what ownership. Okay, that's forfeiture of what share. So what we're saying is that the shareholder or the investor, even though he has paid application allotment, he has paid first and second call, by virtue of his failure to make payment for the second call, okay, within the what grace period, that can result into what losing ownership of the what shares. And where that happens, we say the share has been what forfeited. And in most cases where shares are forfeited, the guy has lost all the money paid before the call. So the amount paid during application allotment has been lost. The amount paid as part of first call has been lost, and then even the one that he has not paid has been lost. So technically, despite the fact that he has made some part payments for the ownership of the shares, but by virtue of the fact that he was not able to make complete payment, okay, so what you get to have in most cases is that what the guy loses what ownership of the what shares, and that is what we refer to as what forfeiture of what shares. And so what happens is that the directors, okay, can now what also what issue that shares to somebody else. So where the share is forfeited by one investor, that is where one investor or shareholder or applicant, okay, loses the ownership of what of his shares, that share that he has lost, the directors now can issue it to what another person or another investor to raise the money that they are what looking for. So in that scenario, now not to waste our time, of course, okay, let's quickly look at what we know, the statement of financial position, okay? So this is our what assets, all right? So we can call it non-current as usual. So let's call this, let's say this is what 800, then let's say current. Let's call it 700. So this is what 1,500. So let's represent it by liabilities here. Okay. Let's say short-term liability. Okay. Let's say 600. Right. And then let's have reserve here. Let's call this 100. Okay. Then our share capital. Okay. Let's call it what's that? 800. All right. Is 800 or 900? This is 800. Yeah, that's it. So we have 00. This is 9. This is 1,005. So you can see that we have a position here. So what you get in most cases is that, okay, upon the issue of the shares, that is the forfeited shares, okay, most times you can have what they call additional premium. Aside from the premium that you have, okay, from issuing the share, which is issuing the share above the nominal value. In the event of reissuing forfeiture of shares, you can have additional premium. So typically, premium is premium. When you have premium, there's what an element of profit, okay, or an element of gain, which is treated as what part of your what reserve. Okay, don't forget that your profit that you made for a particular period is also part of your reserve. So the profit element or gain element on what issue of shares, okay, whether actual issue or issue of forfeiture of shares, that profit element is also part of your what reserve. So it is possible that where the directors reissue the share to somebody else, they might make some additional money on that forfeited what share. So that is also recorded as part of your what the reserve for that what period. So let's go now. Let's take for instance, okay, from this very one here. Of course, we have, that means we're trying to raise. That means one share here is 1 naira. Let's actually want to raise 100 naira. Of course, 100 naira will go to what? 100 what shares, right? That will be at 1 naira what each. Now let's now assume that it is an installment like this. We have application and allotment. That is what 30 kobo, and then we have first call to the 30 kobo, and then we have second call to the what 40 kobo. Of course, if you open your application allotment, right? The guy paid, right? So what do we have here? Application and what? Allotment. Remember, the money is paid into the bank. Okay? So that will be 30 kobo times, that's 30 naira, right? Then what do we have here? First call. Okay? The money is paid into the bank as well. Remember, that's 30 naira, so 30 kobo times 100, that's 30 naira. Right? Now, second call. Now, let's now assume that second call, okay, this second call you're seeing now, let's assume that the guy did not pay. Let's even say all of them. Let's even say, okay, some people paid and then some did not pay. So let's say that there is a 10 units. Let's use 10 units. There's a 10 unit of shares that was not paid for. Okay? So technically, your second call, ordinarily was supposed to have 40 kobo times 100 units. Right? But remember, out of this, you can see now, this 100 units, 10 units was not paid for. So what was paid for will be what? 40 kobo times 90 units. Of course, 40 kobo times 100 units would be 40 naira, but 10 units was not paid for. So 40 kobo times 10 units should be 4 naira. So 40 naira minus 10 naira, that will be 36. And 40 naira minus 4 naira, that will be 36. So that means that in second call, there's a receipt into bank for what? 36 naira. Now, this 10 units that was not paid for, which is of course 4 naira, that's 40 kobo times 10 units, that's 4 naira. Now, if by virtue of the fact that the directors were tried to protect the guy's investment, but the guy could not pay, and then the guy now forfeited the word shares. This 10 unit now, he has lost the word ownership since he could not pay the second word call. Don't forget that he has paid for 10 units here, he has paid for 10 units here, but he couldn't pay for 10 units here. So by virtue of not paying for 10 units here, he has lost everything. So now, the bank will receive 36 naira now by virtue of those that paid for the second call. But this guy that did not pay, what do we call it? We say what? Forfeited what? Shares. Okay? That will be what? 10 units times what? 40, which is what? 4 naira. Alright? So now, remember, this we go to where? Ordinary share capital, 30. Ordinary share capital, 30. We have ordinary share capital here. That will be what? 40. Okay? Now, there is a forfeiture of shares here. We have what we call forfeiture of what? Shares account. Of course, we come here, that will be what? Second call. How much? 4 naira. Now, remember that the directors have the right to reissue this share to some other investors. So they can find investors for it and reissue. So now let's now assume that the director issued these 10 units to somebody else. Let's say X investor. So let's say the directors now issue this 10 units to what? X investor. Let's say at, let's say 50 kobo per what? Share. Now you can see that, what is this now? This is forfeiture of what? Shares, of course, from second call, right? Now, the directors are now reissuing it to where? To whom? To X investor. So that means this money will be forfeiture of shares account. We'll take it to where? X investor's account. How much? 4 naira. So we now open what? X investor. Now, bring it here. Forfeiture of what? Share what? Issue. That be what? 4 naira. So that means we debited this X investor with the 4 naira that this man could not pay for. That's for the 10 units, right? Now, X investor is paying how much? 50 kobo per share. So 50 kobo per share multiplied by 10 units that we are issuing to him, that will be what? 5 naira, right? So that means X investor will pay into our bank how much? 5 naira. So that means in our bank, we're going to receive money from X investor. But don't forget that what we debited X investor is 4 naira, but he has paid 5 naira for the what? Shares. So technically, we made a profit of what? 1 naira. So that means we're going to say premium on what? reissue. How much? 1 naira. So both sides becomes what? 5 naira, 5 naira. Okay? Now in our bank account, look at our bank here. Credit, debit. We got 13 naira from application and allotment. We got 13 naira. We got 13 naira from first call. We got what? 36 naira. Okay? From second call. Then we now got what? 5 naira from what? Ex-investor. So ex-investor paid how much? 5 naira. So total amount of money that went into the bank now will be what? 30 plus 30, 60. 60 plus 36, that's 96, right? 96 plus 5, that's 101. Total amount of money that went to the bank is 101. Okay? And then look at what we now have. Our ordinary share capital now. From application, okay? What do we have? We have application allotments. How much? 30 kobo. First call. What do we have? 30 kobo. Second call. What do we have? 40 kobo. So we can say that our ordinary share capital now has 100 naira nominal value. Now, don't forget there's what? Profit on reissue of 1 naira here. So we're not going to say profit on, or let's call it premium. Premium on what? Reissue. From here, we say ex-investor. How much? 1 naira. Now, don't forget your behaviors. Your assets, debit. Liabilities, credit. Expenses, debit. Okay, income is what? Credit. So, from here now, let's impute. This is closed, this is closed, this is closed. Okay, of course, this is closed. Yeah, 40, 40. This is closed as well. Now, this is also closed. So, bank, how much do we have in bank now? 30, 30, 60. 60 plus 36, that's what? 96 plus 5, 101. So that means we're going to have a bank here of 100 and what? 1. So that means this will change from what? 15 to what? 1601, right? Now, ordinary share capital, can you see? This is 30, 30, this is 100. So that will increase from what? 800 to what? To 900, right? Now, we have what? Premium on reissue, which is 1 naira here. That's credit. Okay? That's more like an income there. So don't forget that the premium is like profit, and profit is like an income, credit balance. And then that will form part of your what? Reserve. What's your reserve? 100 plus 1. That will be 101. Right? So if you add everything up, you're going to have 1, right? 0. This is 9, this is 10, this is 6, 1. You can see 1601, 1601. So what we've done here basically is to what? Illustrate how to account for what? Forfeiture of share. Accounting for the shares, okay, flowing through the what? The call that has been forfeited, or the call that could not be paid for and then lost by the shareholder, and then taking it straight to the account of the person that is now going to buy the share. So basically, forfeiture of shares is more like saying that there's a debt. Don't forget that call in arrears, I told you, is more like the investor is owing the business. But since the investor could not pay, okay, and then that means someone else is now buying the debt. That sort of technicality. So what we're saying here is that the guy could not pay for his shares, so he lost it. The director now was sold it to somebody else and made some money out of it. Do you understand me? So that's the technicalities involved. So this is a summary of accounting for forfeiture of shares. Okay, so if you have questions, you can reach me on the numbers displayed. I'm going to reply you with the right answers. You look at this question so that we can have an idea of what we're talking about here. Okay, so we have the following represents the balance sheet of Jordan Mega PLC. So we have statement of financial position, as an affairs, we have non-current asset, current asset, bank, finance by liabilities, short-term liabilities, reserves, and then we have authorized share capital. There we have 20,000 units. Okay, 20,000 units, 20 million units at 1 naira per share. The ordinary shares issued have 10 million shares issued at 1 naira per share. So we have there. So they're saying here on the 1st January 2011, the company issued 1 million ordinary shares to the public for subscription. All shares are subscribed for with 20 kobo payable on application, 30 kobo payable on allotment, 40 kobo payable on first call, and 50 kobo payable on the second and final call. A shareholder with 20,000 shares could not honor the second call as at when due. After several failed attempts at the directors to return the shareholders' investment, it was decided that the shareholders forfeit the shares. Okay, the forfeited shares were then issued to two new investors, XYZ Limited and ABC Investment, equally at 50 kobo per share. The share issue procedure came to a completion on 31st May 2011. Showed necessary legals or necessary entries to record the shares issued. Okay, so what we are saying here is that the company issued 1 million ordinary shares. Okay, so we have this. We have application allotment, first call and second call. But then there is what do I call it now? Forfeiture of shares. There's a shareholder that could not actually pay for a particular call, and then the shareholder forfeit, that is lost the ownership. And then here the directors issued to some other investors. So let's quickly look at this question here. Okay. We have Judah Mega PLC. Okay. So what do we have there? We have application. Okay. Application there is what? 20 kobo. Allotment there is what? 30 kobo. Then first call. What's the first call there? 40 kobo. What do we have now? Second call, 50 kobo. So if you add up, what do you have there? This is 50, that's 1.40 kobo, right? Yeah. So nominal value, according to the question, 10 million ordinary shares issued at. So we have 1 naira. And that means there's a premium here of how much? 40 kobo. Okay. So what happened there? So let's quickly do what we want to do. So application. We have application here. Okay. Application will be how many share issued there? We have 1 million shares issued. So I'm going to do 20 kobo times 1 million. So this is 200,000. So that will go into the bank. Of course, then straight away, ordinary share capital. So the next one, what do we have? Allotment. $30 kobo, of course, times 1 million. That's 300,000. So that will go to bank. Of course, straight away, ordinary share capital. Yeah. So the next one is first call. That 40 kobo times 1 million. That 400,000. Go straight to the bank. 400,000 straight away. Ordinary share capital. So the next one now, we have second call. Now, what happened to second call? They said, what do we have? A shareholder with 20,000 shares could not honor the second call that went due. So, ordinarily, we're supposed to have 50 kobo times 1 million, right? But there's a shareholder that could not pay for what? 20,000 shares. So basically, what we got will be 50 kobo times, that will be 1 million minus 1 million minus 20,000 times 980,000, because a shareholder could not pay for 20,000 units. Okay, that will be times 0.5, 490. So what went to the bank here will be 490,000. Of course, that will be going to a ordinary share capital. How much is that? 490,000, right? Now, remember that the guy here could not pay and he forfeited the shares. So we have forfeited shares. That will be 20,000 units of shares. Okay? 20,000. So forfeited shares will be 20,000 units of shares times what? 50 kobo. So again, that's how much? 20,000 times 50 kobo. That's 10,000 units. So we have 10,000 naira here forfeited shares, right? Of course, that will be ordinary share capital as well. Right? So this is already 500,000 here. Okay? Another way we can make it easy so that there's no confusion is to what? Lump it up and take it straight to ordinary shares, 500,000. Okay? So that's it here now. We're now opening what? Forfeited what? Shares account now. So this is from second call. How much? 10,000 naira. So they're not saying, they said it was that the shareholders forfeited, and then the forfeited shares were then issued to two new investors, XYZ Limited and ABC Limited, equally. So that means that this shares was reissued to what? New investors. So we have XYZ equally. This guy will take 5,000. Then we have ABC 5,000. So that closes the forfeited shares. We have 10,000, 10,000. So the first guy, which is XYZ Limited, took what? Forfeited shares reissue. Abi? How much? 5,000. That means out of 20,000, he took 10,000. Okay? Because it was equally shared among them. So he took 5,000, but how much did he pay? It was 55 kobo per share. So that would be what? Let's put that somewhere here. So that would be 10,000 units times 55 kobo, right? So 10,000 units times 55 kobo, that's 5,000. So the guy will pay into the bank how much? 5,500. So he was debted 5,000, he paid 5,005. So that means there's a premium on reissue here, Abi, of how much? 500. Okay. So what's the next guy? The next guy is what? ABC Investment. So of course he took forfeited share reissue of 5,000. That's his part. Then he's going to pay to the bank how much? 5,500. So there's a premium here as well. 500. So what do we have? Okay. So let's continue here. So the next thing there, you can see that we've been able to account for the forfeiture of shares, and then we'll be able to reissue it as well. So let's go. Our bank. So how much do we have in the bank account before we issue the share? Bank is 2,205,000. So brought forward here 2,205,000. So from application we got 200. From allotment we got 300. From first call we got 400. From second call we got 490,000. From XYZ we got 5,500. From ABC we got 5,500. So what total amount of money that we have in our bank? So that will be plus 500. 500 plus 500. And plus what? 490,000 plus 400,000 plus 300,000 plus 200,000 plus 2,205,000. So what we have now is a carry down of 3,606,000. 3,606,000. 3,606,000. So our new money in the bank will be 3,606,000. So let's go. Here we have our ordinary share capital. So what's the balance in the share capital before we issue? 10 million. So we have balance brought forward here. 10 million. So from application, we have 200,000. From allotment, we have 300,000. From first call, we have 400,000. From second call, we have 500,000. Okay. Now remember that there's a premium on the share issue, which is 40 kobo. So 40 kobo times 1 million unit there, that's 400,000. So we have premium 400,000. So that will now mean that our carry down will be total here is 10 million plus what? 1.4. That will be 11. So we have 11.4. So 11.4 minus 400,000 here. So that means our carry down will be 11,000. So we have 11,400,000, 11,400,000. So our new share capital will be what? 11 million. Okay, so now let's go. Our share premium. Okay, so from ordinary share capital here, ordinary share capital, we have 400,000. Then don't forget we had what? Some premium on reissue. So premium on what? Reissue. We have 500. Another one here. Or let's just call it. What do we have there? This is from which account? XYZ Limited. XYZ 500. ABC 500. So that's the premium on what we issue. So our premium account will be having 400. Is it 400,000 plus what? 1,000. What do we have there? 401,000. 401,000. 401,000. 401,000. So roll down here we want 401,000. Okay. So having done that, let's show our statement of financial position. So that will be statement of financial position as at 31st May 2011, right? So, of course, at this level, you know what we're talking about here. So, let's go. So, we have our assets, right? Non-current. So, what's the non-current there? 120,000. 10,120,000. Current asset, excluding bank. Current assets, excluding bank. What do we have there? 5,245,000. 5,245,000. Then we have bank, right? Bank. What's our bank? Our bank has changed here. It's 3,606,000. 3,606,000. Okay? So what do we have? 120,000 plus 5,245,000 plus 3,606,000. That will be 18,971,000. So we have 18,971,000. 18,971,000. Okay, so that represents our total asset there. So these are total assets. Right? So let's go, represented by what? Our liabilities now. So what do we have there? Short-term liabilities there. So what's the short-term liabilities? According to the question, we have 3,256,000. 3,256,000. Okay, so we have what now? Our reserves. That would be what? 4,314,000. 4,314,000 plus what do we have in 401,000. So what do we have? 4,314,000 plus 401,000. 4,715,000. 4,715,000. Okay. So what do we have now? 4,715,000 plus 3,256,000. 7,971. 7,971,000. So what do we now have? Our what? Ordinary share capital. Of course, share capital has changed. Where is it? Yeah, 11 million. So we have 11 million. So we add up. This will be 0,001,7,981. This is your total liability. So you can see that our total liabilities here is similar to our total what? Asset. So what we've done here is to be able to account for issue of shares with the scenario of forfeited shares. That is, one of the investors, also one of the shareholder, lost uh, some shares as a result of not being able to pay for a particular call. So directors now reissued the shares to somebody else, okay, or some other investors, if I may use that word. So basically, this is accounting for, you can see us accounting through the what application allotment, first call, second call to the forfeited shares, then to the reissue to their new investors, then the revised ledgers, bank, ordinary share capital, the share premium account, and then the what new position of the business after the what issue of the what share. So you can go through it on your own. If you have questions, you can reach me on the numbers displayed. I'm there to reply you with the right answers.